The webinar will begin in 2 minutes. The webinar will begin in 1 minute. Welcome everyone, and thanks for joining us for today's webinar, 10 Shades of Gray, the Tax Uncertainty Continuum. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email, free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Leinberg, and regularly speaks at industry events. His new book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is now available on Amazon.com. Linus will draw on his legal, tax, and life insurance background and practical experience for today's webinar. And here he is.
Thanks, Jennifer. We're going to talk today about 10 Shades of Gray, which is kind of a provocative title for an important topic. When we work with our clients, we're often helping them manage various kinds of risk, including financial risk and volatility risk, interest rate risk, inflation risk. One of the things that we need to be positioned to help them manage is tax risk, and sometimes communicating tax risk is a challenge. We know sometimes we get, at Advanced Underwriting Consultants, we get calls from producers who don't necessarily understand about tax risk. And certainly our clients are challenged to understand about tax risk. Our objective today with today's topic is to give you a tool so that you can measure tax risk sensibly in a way so that you can talk to your clients about the tax risk that they might be undertaking with various kinds of ideas. But before we jump into the topic, let's decide what we're going to talk about next month. We're going to run a poll, and we'd like your input as to which topic you would like to hear about. The choices are, first of all, the answers that we can't give. Secondly, the most asked questions about Medicaid planning. And then the third choice is helping business owners with business continuation plans, a practical guide. So those are your three choices. The poll is now open, and we would invite you to vote. We'll give you about 45 seconds to enter your vote, starting now. If you haven't casted your vote yet, please do so. We'll give you another second or two before we close it. All right, let's go ahead and close the poll. It looks like next month's topic is going to be helping business owners with business continuation plans, a practical guide. That sounds like fun, and that's what we'll talk about in November. Today we're going to talk about shades of gray with regard to tax planning. So we talk about taxes all the time as we work with our clients. We talk about, the tax favored status of the things that we sell, things like permanent life insurance and annuities. We sometimes position the tax advantages in such a way that it really appeals to the clients, and sometimes the client's decision hinges on the tax results that are described, or perhaps from the client's perspective, promised. And sometimes, the tax rules are really clear and they're straightforward. But other times, the tax results are less clear. And so how do you talk to a client about a situation where the result that perhaps they want isn't for sure? Well, I think then you have to talk about tax risk. The easy out is to suggest to the client that the client needs to get the client's own CPA or tax attorney involved in the decision-making process. But in the real world, that can be a road to nowhere. Sometimes the client won't do it. Sometimes the other professional doesn't know enough to provide meaningful input, and sometimes that it just stops the process completely. And so I think if a financial professional, a life insurance professional, is prepared to talk about ideas that are tax-centered, strategies that are tax-centered, and talk about the risks associated with those ideas, the client's in a position to make at least a temporary decision about what to do, so that the conversation can be moved forward, and then perhaps the tax professionals can be involved in the process later on when the client is actually ready to move. And so that's why I think it's important for you, as you work with your clients and talk about tax risk, for you to have a tool to talk about exactly what level of tax risk that we're talking about. So when you or we are evaluating tax risky ideas, the measuring the amount of risk takes a lot of research and a lot of evaluation. And so as we talk to our clients and their professionals about these ideas, it's helpful if we know what's behind them. Our point today is less about making you experts about the exact nature of a tax risky idea, and more about giving you a tool to help somebody understand where on the risk continuum they might be, whether the idea is less risky or more risky. We're going to talk about specific ideas as we move from the white, meaning no risk at all, to the black, meaning an idea is clearly against the rules. You may disagree with our assessment about certain ideas, but this presentation is less about precisely mapping where a particular idea is on the continuum, and more about showing you how the continuum can be used as a tool to explain tax risk to your client. And so we hope you'll find the tool useful. So I said before that we're moving from white to black, and on the white, white strategies involve clear authority in statute, in case law, or treasury regulations. All of those things can be relied on as precedent by a taxpayer. And one clear example of this is if an insured owns a life insurance policy, names the insured spouse the beneficiary of the life insurance policy, that death benefit at the insured's death is income tax free when it's paid to the spouse. That's clear in the statute. Section 101A of the Internal Revenue Code says that a death benefit is income tax free. And so that's clearly at the white end of the spectrum. Now, the white starts to get a little bit dirty when the authority isn't quite as clear as we would like. It seems to have seems to have at least partial support in the relevant precedents. So here's one example. We get asked about a fair amount in advanced underwriting. Let's say we've got somebody who has a 401k plan, somebody who doesn't own the company, someone who's reached the age of 70 and a half. And normally at 70 and a half, minimum distributions are required from qualified plans, except that there is an exception to that rule. Code section 401A9C says that the required beginning date is April 1st of the year in which the employee retires if it's later than 70 and a half. And so the question is how does that rule apply if someone switches from full-time to part-time? So they're 70 and a half, they switch from full-time to part-time. The question is, can they continue to avoid taking RMDs? And the answer centers around the definition of retires from the statute. The definition that we guess at is retirement means separation from service. And if that's true, then retirement probably doesn't, the definition probably doesn't apply to somebody who is still working part-time. It doesn't quite say that explicitly in the way that we like, but based on the words that are in the statute, it seems like that that there's pretty clear authority supporting the idea that a part-time employee who is not an owner of the company is able to defer RMDs from if the part-time employment is with the employer sponsoring that qualified plan. So that's a smudged white example. So as we move a little bit further along the continuum, let's talk about dirty white, where we've got clear semi-authority. When I talk about semi-authority, what are we talking about? Well, in a lot of cases, we're talking about private letter rulings. Private letter rulings are IRS positions on certain issues. The problem is that the private letter ruling can only be relied on by the taxpayer to whom it is issued. The IRS does publish them, and the words in a private letter ruling are an indication of how the IRS looks at a particular issue, but it's not authority. And so we call that semi-authority. And so if we've got semi-authority, it feels like it's an okay idea, even though we don't have, clear real authority. What's an example of this? Well, it's a loan exchange with regard to Section 1035 exchanges. We have clear authority in the tax code that says one life insurance policy can be exchanged for another income tax free. What we also have is a pretty clear rule that says if you've got a life insurance policy subject to a loan and you trade it for another life insurance policy that has no loan, the loan that disappears is taxed on a gain first basis. And so that's a fairly bad result in many cases. But there's a couple of private letter rulings that say that said where somebody wanted to trade a life policy that had a loan against it for a new life policy that had at least as big a loan or bigger, then that was a valid exchange, and you didn't have taxable boot on any loan that was that disappeared as part of the exchange, because the loan didn't disappear. And so trading life insurance policy with loan for new life insurance policy with loan should be income tax free. We've got a clear letter ruling that said that that was the case, but it was a private letter ruling, so it doesn't apply to us. But it does indicate the IRS's logic, so it's a dirty white part of the continuum. There seems to be clear semi-authority for that idea. So we have a reason to be wary of dirty white, at least a little bit. One example of that is from the Bobrow case from 2014. Taxpayer had two IRAs and tried to rely on what the IRS published in IRS publication 590 that said that there was a 1-year waiting period between rollovers, but they applied separately to each individual IRA. And Mr. Bobrow relied on IRS publication 590 and did multiple IRA rollovers, but 60-day rollovers, but they were done from different IRAs. The tax court decided that Bobrow could not rely on the information in publication 590, that the rollover from the second IRA, the 60-day rollover from the second IRA, was not going to be allowed, and it was going to be treated as a taxable distribution. And so even though we had something published from the IRS that said you could do this, the tax court said that that wasn't precedent, and that its interpretation of the statute would lead the taxpayer down a different path. And so why do we bring this up? We bring it up to say that if you've got an idea that's in the dirty white, it's not necessarily safe. It is potentially subject to attack. And so I think you got to warn your taxpayer about ideas that move down the continuum. As we move further down the continuum, let's talk about light gray ideas. Light gray strategies have indirect support in things like private letter rulings or other information that's been published by the service. What's one example of this? Well, we've got chronic illness riders to life insurance policies that are accelerations of the death benefit. And Code Section 101G says that such accelerations where the insured owns the contract are going to be income tax free. They're going to be treated like the tax-free death benefit. And so that part of the authority is clear. But what about if we have an acceleration on a policy that is not owned by the insured? Well, if we've got a business that owns the contract, the tax code is also explicit that in that case the acceleration is not treated as a tax-free death benefit. But where we've got a family member, perhaps other than the insured, owning the contract, it's ambiguous as to whether or not the chronic illness acceleration is going to be treated as a tax-free death benefit. And so because it's clearly ambiguous, the code is silent on it. We've got unclear semi-authority. What is the semi-authority? Well, since the tax code took the time and the effort to point out that an acceleration when paid to a business is not income tax free, since it's silent about if a third party other than the insured owns the contract, our best guess is that it should be income tax free under those circumstances. But it is a guess, and therefore it is unclear semi-authority. And so it's in the light gray by our assessment. So as we move down the continuum, we're now at salt and pepper. We've got no direct authority in salt and pepper situations for particular tax positions. And so our advocates of salt and pepper ideas will rely on logic only. Salt and pepper, from our perspective, rely on strong logic. We can argue about what strong logic is, but let's give an example of what we think salt and pepper is. And let's talk about restricted bonus plans. we're familiar with bonus plans. Bonus plans are deductible because they're extra compensation to employees. With restricted bonus plans, we get into a little bit more trouble because we have to deal with Code Section 264, which says that if the employer is in any way an owner or a beneficiary of a life insurance policy, it may not take a tax deduction for the premium. And so, with a restricted bonus arrangement, the employee is treated as having gotten extra money and is paying that extra money for the life insurance premium. But the employee's access to the life insurance policy and its benefits is somehow restricted by an agreement with the employer. And the question is, how much of a restriction can the employer impose? In some cases, the employer wants to get back the money that it has put into the bonus plan, or wants to try to get back the money that it has put into the bonus plan. And the question is, can that be done? And the answer is, we don't know for sure. In a lot of cases, rather than a security interest in the life insurance policy by the employer, which seems to maybe run afoul of Section 264 issues, they might have a side agreement between the employer and the employee that says that if the employee leaves early, the employee owes the employer money. And the question is, if that's done in conjunction with a bonus plan that the employee uses to buy life insurance, does that screw up the deductibility of the bonus on the front end? And the answer is, we don't know. Logic tells us that if it's a side agreement not tied to the life insurance, that is the employee's obligation to repay the employer, that it's probably okay, but we only have logic. We don't have anything that we can point to for sure in case law or regulations that says one way or the other. So that's why that kind of idea is a salt and pepper plan, at least in our assessment. So moving down the gradient, the continuum, we're now in the medium gray. We've got some hope that logic will prevail over authority or semi-authority. An example of this is we've got a client with two separate IRAs, and the client buys an immediate annuity with one of the IRAs, and it pays more than an RMD. Another way to say it is the immediate annuity is for a term less than or shorter than life expectancy. Can excess payments be used to satisfy a portion of the other IRA's RMDs? And we don't know the answer, like almost all of the examples that we're giving. We think that it may be possible that the IRS one day may say that an IRA annuitized for a period shorter than life expectancy, that some portion of that excess payment may be used to satisfy an RMD from another IRA. But we've also got a troubling regulation from the IRA that says once an IRA is annuitized for a period of life expectancy or shorter, the annuitization payment will satisfy only the RMD obligation for the account that's been annuitized. And so we've got some tension between logic and what is the authority. And so that's why this particular idea that you can use a SPIA distribution for the RMD obligation from a different IRA, we would say that that is in the medium gray of the continuum. Now we're moving to the dark gray on the continuum. We've got hopeful logic only. Example of this is an exchange of life insurance for an annuity is income tax free. Some advisors have argued that you should be able to do the same thing with term insurance. The term premium should count as basis, and you can do an exchange of a term policy for an annuity and increase basis in the annuity contract and shield gains from income taxation for a long time, depending on the amount of term insurance premium that you exchange over. We don't have anything from the IRS that says this for sure. Nothing in Code Section 1035 says term insurance. Of course, none of it says permanent insurance either. So we're hopeful that this logic could work. Many of the carriers feel like this is risky. Some carriers may allow for it, but it is based on hopeful logic only. We don't have anything explicit from the IRS that says you can exchange term life insurance for an annuity or for other term insurance and carry over the term premium as basis. So now we're in dirty mulch. We've only got stressed logic. It says login, but let's say stressed logic only. A lot of times advocates of an idea will present arguments in favor of idea. They'll downplay more reasonable IRS arguments or semi-authority that go against that strategy. We put those kinds of strategies in the dirty mulch section. One example, prior to 2006, some planners advocated private annuity trusts as a way for a taxpayer to stretch out capital gains taxes on the sale of an appreciated capital asset. Since 2006, the IRS has proposed regulations that would change that tax result, and so anybody who still goes down that path is probably in the dirty mulch area. It's only stretched logic that would apply. The IRS has proposed regulations, hasn't actually published regulations, which is why this isn't necessarily in the black. If dirty mulch is very risky, the next step is the fertilizer step, which is bad logic, stretch only. For those of you who have been in the business for years probably are aware that 10 years or more ago, people used to advocate Section 419 plans and VEBAs as a way for a business owner to take a tax deduction and to buy permanent life insurance inside of a 419 plan or a VEBA plan. It was a way for the business owner to pay for needed permanent life insurance coverage with tax-deductible money. Since those ideas became popular, the IRS decided that those transactions are transactions of interest, listed transactions, and so everyone's been put on notice that the IRS doesn't think that these ideas work. And not only that, if you don't tell the IRS about the fact that you're putting those ideas into play, that you're liable for extra penalties if you don't tell the IRS about them. Having said that, I've certainly seen some stuff, even since the IRS decided that those were listed transactions, where people are still advocating VEBAs and Section 419 plans, saying that ours are different. That the IRS logic doesn't apply to our plans. Well, I think that's a terrible risk that you'd be putting your client into if you put your client into such a plan. And so we would term such plans as on the fertilizer end of the spectrum. And then finally, we're at the black. We have specific authority against a particular plan. The clearest example is, business owner pays for life insurance that the business owns on a key person. The question is the premium tax deductible? And the answer is clearly no. Section 264 of the Internal Revenue Code says that the answer is no. Having said that, we certainly know about situations where people, and even CPAs in some situations, have claimed an income tax deduction for the premium, but there is explicit authority against that, and so it is on the black end of the continuum. So, as I said at the beginning, some are going to disagree about where we place certain strategies on our continuum. That's okay with me. I don't really want to get into an argument with anybody over where any particular idea falls. But what we really want to do is give you a tool. We want to give you a tool so that you understand that there are risks associated with certain ideas. We give you a tool so that you can make your own assessment about where a particular idea falls on the continuum, so that you can make an assessment about what kinds of ideas, where they fall on the continuum that you are personally comfortable showing your clients, and also so that you've got a way to explain these ideas to your clients as you are going forward. At the end of the day, we want you to be able to serve your clients as well as you can, and helping them measure tax risk so that they can implement the sensible ideas, so that you can work sensibly with them and their advisors. If we can do that, we can help you with that kind of tool, then we will have succeeded with today's webinar. And at this point, I want to turn the program back over to Jennifer.
Thanks, Linus, and thanks for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. And don't forget to join us next month for Helping Business Owners, a Practical Guide. You may also email questions related to today's webinar to me. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.